Thanks for joining today's episode of the Macrocast. I'm your host, Ylan, a managing director at Penta. We've got a full house back in session. John Fagan and Brendan Walsh of Markets Policy Partners are back with me. Also on the mic is John Dick, CEO of Civic Science. How's everybody doing today?
Doing great, Ylan. It's great to be back.
Fantastic. Well, I feel like today we have a lot to discuss around the consumer. We've been talking a lot about how resilient households have been throughout this recovery. We see it in some of the data, like the recent retail sales numbers. But at the same time, there are some cracks beneath the surface and perhaps some roadblocks ahead. We see credit card balances up, mortgage rates at the highest level in 2 decades. So, John Dick, I'd like to start with you because we did see a big decline in the economic sentiment index that Penta puts out with Civic Science. We saw a drop of 1.4 points, and that's the third biggest decrease so far this year. So what's going on?
Well, I mean, I think people may be coming back to reality just a little bit. You're right. I mean, not only was it a big drop, but its second consecutive drop. We haven't had many consecutive 2-week declines, and I think maybe just once this year. Yeah, I think maybe what it's saying a little bit was that some of those really good feelings in the early part of summer were maybe a bit more emotional than they were realistic for consumers. I think they were psyched to get to summer, psyched to get to vacation season. The sort of wellness adventure everybody's been on this year was sort of peaked in July and in June and July, and we're maybe coming a little bit back to reality. What's I guess maybe a little ironic is that of our 5 major indicators, they all fell. Outlook, a 6-month outlook for the U.S. economy sort of fell at the steepest rate, which means people kind of don't expect things maybe to be getting better before the end of the year. But what was maybe a bit ironic was that their views of their personal finances, so their actual real financial status, actually fell the least. So just, a couple basis points. So people aren't necessarily feeling like their financial picture has changed that much, but their outlook for the next few months is getting a little bit drearier. Now, as you mentioned, with credit card balances rising, also defaults rising to sort of pre-pandemic levels, that might also say that even their views of their personal finances are a little bit maybe unrealistically optimistic. But yeah, it'll be interesting to see how this unfolds. We still have, as we talked about the last time I was with you all, the impending return of student loan debt in a month or so, or student loan payments, excuse me. And so whether people are anticipating that in these numbers, I don't know, but they're definitely going to feel it. That's going to be a lot of money coming out of people's pockets in about 60 days. So it'll be interesting to see if this downward trend continues.
There were some negative headlines that came out in the past 2 weeks around Fitch downgrading U.S. debt, downgrading some regional banks. Did that trickle through to the consumer at all, do you think, or is that just kind of white noise at this point?
No, I mean, at least in our data, we see signs of that. Trust in banks, which is something we watch very closely with consumers, had sort of, kind of bottomed out a bit right after the Silicon Valley Bank collapse and had normalized for a couple of months or so. But with that news a couple of weeks ago or whatever it was, I guess it was last week, that sort of trust indicator fell again. So not quite as bad as it was immediately in the wake of SVB, but not great. I mean, consumers do pay attention to those kinds of things, particularly given the large percentage of U.S. Consumers who bank with small and regional banks. It's a real thing.
John and Brendan, do you guys see the economic sentiment index as somewhat of a leading indicator then perhaps? Because we are seeing strong spending numbers. I mean, even beating what the market had expected consumers to do. So perhaps the ESI is a sign of what's to come versus where consumers are right now.
I think that's fair to say. And, thinking about the way in which consumers are orienting themselves, even the Walmart had earnings this week, and management came out and said they were surprised by consumers' willingness to spend. That isn't something you would necessarily expect to hear from Walmart management. Walmart had a perky quarter. But its stock ended up falling. That was kind of, caught up in the downdraft this week. We could talk a little bit more about the downside drivers, including China and so forth. But, there was sort of a a sense that, maybe the outlook really was pretty strong for Walmart. They upgraded their profit viewpoint, but some of this is just the operational efficiencies that they're gaining. We saw that in Target as well. Target came out and they're they got a pop in their stock after their results. And there was a sense that some of the challenges that they're facing in terms of inventories had been worked through. And we also got the retail sales data this week. Brendan can talk a little bit more about that. But another month of upside surprise, expansion, and growth in retail sales. So there are some obviously like the various lights flashing amber on the dashboard. But that's been the case for a while. And so there's, a sense that if the consumer hasn't cracked by now, maybe they won't. I think that's maybe a little bit optimistic because, there are headwinds, obviously, that we're seeing. And some of the upswing, we've had a really nice year for financial markets this year. It's had this kind of, the calm after the storm last year has maybe been, this wealth effect may have had something to do with the way that the consumers are feeling about the health of the economy. We know that the stock market isn't the economy, but it is, a part of, financial conditions and loosening. And we've seen that go into reverse this week.
John, I was really fascinated by the Walmart earnings for a couple reasons. One, it didn't include July, right? So I believe that just went through their June second quarter. And so that didn't even capture what was likely a nice online retail boost they saw from the major shopping event, whatever Walmart Days was. And even when we looked at the July retail numbers, the big boost came from online, came from e-com, and that was I'm sure certain that in no small part attributable to Amazon Prime Days and all the other retailer events. So it'll be interesting to see, did people front load a lot of spending? Even we saw in our data, people were buying even earlier for holiday in July. So were they front loading the absolute dollar value of spending because they got such great discounts? And is that going to sort of trickle into sort of lower numbers in August, September, and so forth because people got ahead of the game? We just don't know yet. But Walmart also benefited from what's happening is just a lot of trading down from other retailers. I know Target wasn't punished as much, but they did not report a glowing quarter the way that Walmart did. Part of that was attributable to a bit of the political turmoil Target got caught up in around Pride Month, and we believe Walmart benefited from that. That's where those people went to shop instead. So those kinds of things you think will normalize a bit in the months ahead.
Yeah, absolutely fair point about Target. The bump in their stock was also after the stock had been coming into earnings down 16%. It was really a dog, and you can see that kind of disproportionate upside response if it's not as bad as all that given those declines. Home Depot was more on the sober side in its earnings reports, talking about the wariness among some of its customers of big purchases and major projects. And I think that sort of speaks to what you just said, John, which is that, it trading down, making purchases to, a more judicious decision. Maybe that's the sort of precursor to a fall in which the consumers really do hunker down and retrench to a greater degree.
Brendan, what jumped out to you in the retail sales numbers? I mean, the online piece definitely I thought was super interesting, and wondering also if, the interest in the Amazon days and the Walmart days, again, is part of that hunt for savings and that hunt for a deal. Back in the day, I used to call it spavings, where you had to spend to save, I'm still going to stand by that. I can use that as some justification for purchases, but what did you see that was interesting?
Yeah, I think it's not shocking. We know Amazon Prime Days that, and other people do, online discounts around that. So the online shopping was very strong, but people are still buying cars and things like that, even with the higher rates. So consumers kind of hanging in there. But I think, as you guys were saying earlier, we went through this very large tightening cycle, and that works with a lag. And I think now we're kind of starting to see that lag, affecting the businesses and the consumer. So it's not that we have to fall off a cliff, but I think things are definitely starting to slow down a bit.
John Dick, we've talked a lot about the desire for premium products, like in the beauty category as one example. Are you seeing a bifurcation then when we think about the strength of Walmart's performance, the demand for lower price goods, but yet still seeing a demand for that premium, maybe even more experiential product?
I don't know if premium is necessary. I mean, in some categories like beauty, I know we talked about that last time. It is sort of a premium and prestige. It's a category where people seem to be willing to continue to spend up, but we definitely see the bifurcation, the other side of that coin, where they're spending down in sort of maybe household cleaning categories, things that don't necessarily sort of contribute to their emotional and mental wellness. Right? We saw, July was an epic travel month, so people are still, even in the face of, rising gas prices and things like that, we're still willing to get in their cars or get on a plane and head out of town to get away just to kind of feel better. But people seem to be kind of, well, I don't know if it's conscious or intentional, but even with things like dining out, we're seeing some trading down happen, but a fascinating things happening like in the QSR category. The largest check sizes that we see across QSR restaurants are coming from their lower income customers. So what's happening is people are saying, I'm going to, instead of taking my family out to eat at this place, I'm going to go to a McDonald's or a Wendy's instead, but I'm going to treat it as an occasion. So I'm still going to buy, it's not I'm popping in to get a burger through the drive-thru. I'm going to bring my family in to sit down and eat together because that sort of experience is what's important to them. So there's a very, very clear kind of, I don't know if bifurcation, if it's like symmetrical quite, but we're definitely seeing consumers consciously or not trade down in certain categories to maintain that sort of experience in categories that matter more to them. And
we haven't gotten, I believe, correct me if I'm wrong here, but we haven't gotten the data around spending on services, right, for the month of July. So I'm wondering maybe if just compared to the retail sales numbers, do consumers shift their spending more towards goods and products versus services? Or is there just going to be an overall lift? And it sounds like it might be the latter, where they're spending on travel, they're spending on their experiences, and they're buying a lot of stuff too.
I don't know I don't know if I have a crystal ball on that right now. At some point, goods do show back up in back to school retail. They show up in, early holiday apparel purchases going into the cold weather months. So, at some point, those goods become necessities, right? And so will we see, maybe a decrease in vacationing in the fall? I mean, we typically do anyway, but on a year over year basis, I would expect to see that. But, in the first half of the year, Americans vacationed more than they have in over a decade. So is that going to continue, or did they sort of blow the wad in the first half of the year and pull back in the second half? You could certainly argue that, make that prediction fairly reasonably.
Yeah, and it seems like household balance sheets are maybe looking a little bit more like they did pre-pandemic, right? Consumers have spent down a lot of that cash that they had from the fiscal stimulus during the post-pandemic period. It looks like they still have more savings than they did pre-pandemic, but they also are starting to garner a little bit more debt as well, both in terms of credit cards and, again, with mortgage rates, over 7% now.
Yeah. And look, I mean, we still also have to remember how, again, bifurcation, right? I mean, the job market for the sort of middle to lower income households is still good. Wages are good, right? I mean, we see the headlines of layoffs in big tech and, big commerce, but that's kind of like your 1% category folks, right? It's they're able to find other jobs or get, 6-month severance packages, things like that to help them weather it. But, the majority of the US population is not in that group, and that sort of lower, at least not at the top income households still, maybe at least better off on a job and on wage basis than they were even in 2019.
Well, we know that the Fed is also going to be closely watching how consumers are evolving, what they're continuing to spend on, if they even continue to spend. So let's take a short break. And when we come back, we'll talk more about the Federal Reserve and also what's happening with China's economy. Stay tuned.
Penta is the world's first comprehensive stakeholder solutions firm. We are a one-stop shop for the intelligence and strategy leaders need to assess a company's reputation and make decisions that improve their positioning. As executives in the C-suite must account for a growing set of engaged stakeholders, all with distinct, fast-changing demands, Penta provides real-time intelligence and strategy solutions. We work with clients solving complex global challenges across a variety of industries. Our clients span technology, financial services, energy, healthcare, and more. To learn more about how Penta can support your company, check out our website at pentagroup.co, our Twitter at PentaGRP, or find us on LinkedIn at Penta Group.
And we're back with the Macrocast. To hike or not to hike? That is the question. The minutes from the Federal Reserve's latest policy-setting meeting show officials want more proof that inflation is cooling, even though markets think that rate cuts are on the way. Now, John and Brendan, I know you guys have been saying for a while that you think that the Fed is going to have to hold not just through the end of 2023, but through 2024. Maybe markets are getting this wrong. But what was your takeaway from the Fed minutes? It seems like the Fed is not taking rate cuts off the table.
Yeah, absolutely. And that is really something that is part of their communication strategy. And it's understandable why the Fed would want to give themselves optionality, why they don't want to hang a mission accomplished banner. They want to do exactly the opposite. They want to make sure that the gains that they have made in suppressing inflation are not reversed by an announcement effect or drum roll, please, we're done with tightening, and markets tend to go bananas when that happens. So this is going to be, we think the Fed is going to be playing cat and mouse with the markets over the next few meetings, pretty much in this vein, continuing to flag upside risks of inflation, essentially couching it, if inflation proves stickier than expected or worse than expected, then we will hike rates again, and keeping the market on their toes. Really, I think is going to be the game plan. I think we're going to see that front and center in the remarks by Fed Chair Powell at the upcoming retreat in Jackson Hole, which they do every August. And the minutes, though, were pretty balanced, even though the headline grabber was really, upside risk to inflation, additional rate hikes on the table. The minutes also acknowledged the expectation that the economy is going to slow in the back half of this year, and that unemployment is going to rise in the back half of this year as a consequence of the Fed's inflation fighting policies. There's, certainly the committee was unanimous in hiking rates, but the minutes revealed that there were two FOMC members that were advocating for another hold after the June hold of rates. So this is definitely we take them at face value when they say that they are data dependent, but we think that the burden of proof is really shifted to the hawks to point to specific data that says, okay, this means we need to hike, and that they have to point to something that's gonna tip the scales, because we think the Fed is on hold unless the data forces them otherwise.
You said something interesting, John, which is the Fed is playing cat and mouse a little bit with the markets, but I wonder if it's also, consumers versus the Fed. Just as we were talking about in the first half of the show, Fed keeps hiking, consumers, at least so far, keep spending. And to what degree does that factor into the Fed's decision? Maybe the Fed feels like it can sneak in a couple more because consumers have been so resilient.
I think that the only reason that the Fed has has gone into this pausing cycle really is not because they see growth flagging. It's because they see inflation coming down. And that if they saw a clearer, if it were absolutely clear that the fortitude of the consumer and the resilience of the labor market was an inflationary kind of dynamic, and we're reversing some of the progress that had been made in suppressing inflation, then they would, then faster growth would probably be more of a factor in their decisions. But at this point, they're really targeting the inflation, and they've highlighted that. There's a lot of discussion. The questions in to Chair Powell after the hike in July centered around that. Well, are you going to keep hiking until the unemployment rate goes up? And they said, well, clarify that that's not the target we're trying to hit. We're trying to hit lower inflation. And if we can do that without outsized job losses, then that's what we want to do.
And they're going to have, like we talked about last week, a confusing messaging coming in the next, half year, because we know that the housing component is going to fall off a cliff because it's a 12-month lag. So in the first quarter of 2024, there's a good chance that the year-over-year core inflation rate will be negative, and we will have a bunch of negative, monthly data. So, how can the Fed tell the American public that they have to hike because inflation is out of control when it's actually negative, when we're in a deflationary environment?
Yeah, it's hard for the public to maybe understand baseline effects, right? So that's a difficult messaging challenge there. But what is going on though with markets sort of starting to price back in rate cuts in early 2024? Do you guys think are they factoring in this potential housing, I don't want to say bubble burst because that's not what it is, but this sort of the lag effect on housing from higher mortgage rates, et cetera? Is that what they're factoring in for next year? Because I was surprised to see that Goldman Sachs is now predicting rate cuts in the second quarter.
Yeah, the Treasury market has been in, a little bit of a choppy period here. And so, you basically laid out, Ylan, some of the considerations that are, they're working to suppress the longer dated interest rates, yields on treasuries. This is essentially where the drama has played out over the last couple of weeks, has been in the longer end. The 10 and 30 year has been the big, this has been a big swing factor. We've seen those yields go up a lot. The sort of more policy driven front end 2 year hasn't really changed that much. It's kind of hovering, below 5%, which is, consistent with this higher for longer idea that the Fed is putting out there. But, the 10 year has been really torqued a lot. And in the past few weeks with yields going up. And this is despite an expectation persistent expectation in financial markets that, growth is going to slow from here. And there are a lot of demand concerns emanating from China. We'll talk more about that. But, the upside factors to yields have been, over the long term, that increasing acceptance of a sticky sort of inflation reality, energy prices being firm, has been an upward factor for longer dated treasury yields. A sense that, the Fed's higher for longer message is beginning to seek in and beginning to permeate out into the longer end of the curve. But also, other factors like quantitative tightening, China's treasury sales, and the flood of supply that Treasury is issuing, and that is all going to the other side of the balance sheet on Treasuries. And the other thing is, other global central banks. We saw the Bank of Japan recently at the end of July concede on their yield curve control. That sort of unleashed the back end of their Treasury, of their government yield curve, and that exerted pressure on Treasuries, longer dated Treasuries. It's a very fragile and big macro considerations on both sides, and it looks like the 10-year Treasury yield is just in a real tug of war here at current levels, which are the highest they've been since 2007. So it's a lofty place.
Can I ask a basic question here, which is Fitch downgraded U.S. debt over concerns of the debt to GDP ratio, et cetera. Why wasn't that, or maybe it was, I don't think it was. Why wasn't that a bigger moment when for months and months and months, we talked about the potential, debt ceiling crisis, et cetera. The downgrade was a pivotal moment back in, 2011. I feel like the Fitch downgrade this time around did not seem to be as impactful because it was more about sort of systemic issues that we all knew were there. But it seems like those issues are only getting worse as interest rates rise, and that adds to the U.S. debt.
Yeah, that's the classic vicious cycle that you see, that you always tend to see in like emerging markets, and now the UK, so where the confidence declines in the country's economy and the country's economic management and debt, and you get the sovereign bonds of that country selling off, which compounds the problem, and it's a very negative cycle. In the U.S., the way that the Treasury market trades in periods of deteriorating market sentiment is the Treasury. It's a safe haven asset. So Treasuries tend to rally. And so that's always been kind of this saving grace for the U.S. It's part of the exorbitant privilege, I guess, that comes with the dollar as the reserve currency, the most trusted store of value. Treasuries as the exemplar of the risk-free rate around the world, so that even when the 2011 downgrade occurred and S&P kind of shocked the world with it, what did treasuries do? They rallied because what else are you going to buy when equities are down and risk sentiment is curdling? You still stampede to the stability of the treasury market, and so that is always that paradoxical moment. So is Fitch an issue? Our view has been that there was a nothing to see here. It was no new information, as you said, but it's not it's not clear the way in which debt dynamics and concerns about those debt dynamics really impact the treasury market, given its safe haven status. It just changes the way it trades relative to other bond markets.
No, that makes a lot of sense. And I appreciate you trying to clarify that because it is a little bit counterintuitive. And so it's just surprising to see what's happening in the treasury markets, given all the news that we've had over the past couple of weeks. But where we have seen problems surrounding debt and potential downgrades, et cetera, is in China, where the central bank is looking to ease already. It's not 2024, it's now.
Yeah, that's right. Surprise rate cut this week from the People's Bank of China. Beijing had been very, increasingly vocal over recent weeks about trying to stimulate the economy, about trying to head off some of the problems that appeared to be resurfacing in the, legacy credit issues, particularly in the property sector. But that spills over into shadow banking and all of these wealth management products that they sell to retail and the local government financing vehicles that are very much tied into property prices. Anybody that lived through the 2008, 2009 crisis will recognize these vectors of volatility and disorder as mispriced property assets kind of cascade through the financial system. And in China, with a very property centric economy, it's magnified to a great degree. It's we've seen this. We've seen and Wall Street Journal this morning, right on cue. Is this China? Investors question whether this is China's Lehman moment, right? And China's Lehman moment has been predicted, like every year since 2010. I don't want to make light of that. They really have serious structural problems, but over the economy, they seem to have these waves of nausea. When you get a big failure, like 2 years ago, Evergrande, the property giant, went bust, and it was a horrible period for a short amount of time. They circled the wagons in Beijing, dumped enough state capital and sort of wherewithal behind it, and managed to right the ship and continue. We've seen this again and again. The Beijing does as what they need to do to forestall a disorderly market event. Some would say that they should just let it happen, have a cathartic, clearing of the market. That's what they need. But Beijing just not going to operate that way. They can't take that kind of risk. So we're seeing it again. The rate cuts, the interventions to shore up the currency, which has been flagging. Is now at like its weakest level since 2007, 2008. We're against the dollar. The stock market, the Hong Kong Hang Seng is down double digits this year, where it's the worst performing market in the world among them, and trying to shore up, do these little tweaks to help to try to shore up asset values, but it's all kind of small ball, and our expectation is that they don't let things really go to pieces. They have enough policy wherewithal and firepower to prevent the worst case scenario, but it's not a vibrant economy. And we see these periodic problems where structural issues resurface. They never seriously address the root cause of it. It's a very big challenge. We think they probably stave off a crisis again, but that it's not a place where you want to really, buy into a big recovery story. We think it's a mirage.
Yeah, Brendan, I was going to ask whether there's any lessons for the U.S. from what's happening in China, but maybe it's really the other way around, what China should have learned from the U.S. back in 2008, 2009.
Yeah, it's kind of amazing. Everyone kind of thought that, the course that Japan took would be the one that China has taken, and because of policy choices, I think that they're going the opposite direction, and that's not even talking about their desire to eventually invade Taiwan.
Well, this actually brings up an interesting point, which is if China's economy is on the rocks, officially or not, whether the leaders of China admit it or not, what does that mean for U.S.-China relations? Does that put China in a weaker spot and perhaps allow for some thawing of tensions? Maybe that's too hopeful.
It hasn't really been President Xi's playbook to make concessions in order to shore up the economy. This has been one where they tend to blame external actors for domestic problems, and we think that that's probably going to be what happens again. There was reports, despite all this tension, there were reports this morning that Beijing is considering some countermeasures against U.S. chip, the U.S. chip restrictions that have prevented some of the most highly developed chips from going to China. And so, those seem to be operating on sort of parallel tracks. Beijing trying to shore up its property sector and stimulate its consumption, while without making big concessions to the U.S. because there's not really clear what the U.S. could really give them at this point anyway. That would be helpful. I don't think anybody really thinks that the Biden administration or a successive administration is going to pull back from some of these national security oriented prohibitions on chip and other strategic technology supplies.
Well, one other thing that we need to be on the lookout for coming from China are those magic mushrooms that apparently have been so popular throughout the country that Janet Yellen ended up eating during her trip to China. I don't know if that was a plant. It is a plant, right? Oh, I guess it's a fungus, but I don't know if that was an intentional plant or if that was merely an accident. But I thought that was a pretty notable moment in her trip to China that is just now sort of coming to light. And I was texting with a friend who used to work at Treasury who said, I can't believe this happened. Understand how someone may not fully comprehend what's on the menu in a Chinese restaurant, but you never want the Treasury Secretary eating magic mushrooms during an international trip.
I don't know. You never know. It can expand your mind potentially, and open up some doors of perception that might lead to some fascinating economic reform ideas. So, hey, it's she seemed to be pretty cheery about the whole experience. So
she said that there were no ill effects that anyone suffered. But my follow-up question to that would
ill effects
exactly. Would you consider hallucinogenics an ill effect or not? John Dick, is there any consumer data on psilocybin?
Oh man, I mean, believe it or not, yes, growing support for legalization for first medical and eventually recreational, believe it or not, as knowledge sort of, I think legalizing marijuana sort of opened the floodgates a bit. And believe it or not, yes, we've actually seen rising public support. It's still not in the majority by any means, but it's climbing. Not unlike the way legalized marijuana did 15 years ago when we started tracking that.
Yeah, hallucinogenics. I don't know. Reality's weird enough these days. I don't know if you need it. Save your money.
Well, I think that is a good place to leave our show for today. That does it for us. I'm Ylan Mui with Penta. My co-hosts are Brendan and John from Markets Policy Partners. John Dick of Civic Science also joined in the fun. We hope that you enjoyed our show. Please remember to like and subscribe to the Macrocast wherever you get your podcasts. Thanks for listening.